Welcome to the Daily Consolidation, your 15-minute briefing on today's market action. We break down the day's most important moves on Wall Street, delivered right after the closing bell. Please note, this is an AI-generated podcast, and the views shared here are for educational and informational purposes only. Nothing we discuss should be considered personalized financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions. Now let's dive in.
Okay, so we closed today, and the NASDAQ and S&P 500, they eked out these small gains. The S&P up just, what, 0.17%?
Barely green, yeah.
But looking at those numbers, it just doesn't capture the feeling, does it? There's this real sense of unease under the surface. It sort of felt like, being in a huge party where only 5 people are dancing and everyone else is kind of looking for the door.
That's a great analogy. That feeling of isolation. It may be psychological whiplash. It perfectly captures the internal dysfunction we saw. The headline numbers are, frankly, really misleading today.
Oh, no, so we'll put it this way. The S&P 500 index finished higher, but, and this is the key part, over 80% of the actual stocks in that index went down.
80%?
Yeah.
Seriously?
Yeah.
It's incredible. So only 1 out of every 5 companies in the S&P actually went up. How does the index even manage to rise then?
It really highlights the extreme concentration we've been talking about, market breadth, how many stocks are actually participating in the move. It was historically terrible today.
Okay.
And if you look wider at the NYSE, the numbers were pretty alarming. We had 1,783 stocks falling compared to only 793 going up.
Wow.
That's a decliner to advancer ratio of more than 2 to 1. So for every single stock that gained ground, more than 2 were getting sold off, sometimes aggressively.
So historically speaking, what does that kind of split usually mean? Is it just noise, or is this a genuine warning signal for the rally?
It's a very bright yellow light, maybe even flashing red for some analysts. History suggests this kind of extreme concentration, where just a handful of giants pull everything up while most stocks fall. It's often a late cycle characteristic.
Light cycle.
Meaning that when investors get nervous, maybe about the economy or global stuff, they don't always just sell everything. Instead, they tend to seek out what they see as scarce opportunities and safety. And right now, that perceived safety and growth seems to be almost exclusively in a few huge AI-related names.
Ah, okay. So nervous investors pull money from, say, mid-caps or industrials and just jam it into the few big tech stocks they think can't lose.
That's exactly the dynamic. It's a flight to perceived quality and also momentum. You even saw it in the Dow Jones Industrial Average, which gives you a bit of a broader picture than the NASDAQ, right? It fell almost 0.5% today, below 47,400. So the main index gains, they look like confidence on the surface, but the thousands of stocks underneath, they're really signaling caution.
Which leads to the big question. If 80% of the market was weak, what on earth was strong enough to counteract all that selling and pull the S&P positive?
AI, specifically AI infrastructure spending. It was like a gravitational force today. We saw announcements totaling nearly $50 billion in new committed spending, all centered around building out the AI ecosystem and mostly involving NVIDIA technology.
$50 billion in one day. That's staggering. Let's break down those deals because that number is almost hard to process.
Okay, the first one, and maybe the more strategically interesting one, was between OpenAI and Amazon Web Services, AWS.
Right.
OpenAI committed to a $38 billion deal for cloud capacity on AWS. And a huge part of that involves using hundreds of thousands of NVIDIA GPUs.
Yeah.
Now, the really key thing here, this is OpenAI's first major deal with AWS.
Ah, so they're diversifying away from Microsoft a bit.
Exactly. It reduces their heavy dependence on Microsoft Azure, strategically spreading their infrastructure bets. A big win for Amazon in the cloud space.
Okay, huge deal. What was the other nearly $10 billion piece?
That came from Microsoft, actually. It kind of signals that even if they lost some OpenAI exclusivity, they're still all in on the AI build-out. They signed a $9.7 billion multi-year deal with Iron, a data center company.
Okay.
And that's for access to those top-tier NVIDIA GB300 GPUs. So you add those 2 deals up, nearly $50 billion flowing straight into that specific AI infrastructure pipeline. That explains why the index held up despite the broader weakness.
And why specific stocks flew. Amazon up 4%, Micron jumped almost 5%, NVIDIA itself gained 2%. It makes sense. But you're saying this was like a completely isolated pocket of strength? It didn't lift anyone else?
Not really, no. It was incredibly isolated. Tech was pretty much the only sector showing any real gains. It's just a continuation of this super narrow leadership we've seen building for months now. Like we said, over 400 stocks in the S&P 500 were down.
Right.
This isolation just underscores the main structural risk people are watching, this intense concentration.
We have talked about concentration risk before. Remind us just how dominant these top few names have become.
Well, the group often called the Magnificent Seven, the biggest tech stocks. They now account for roughly 30% of the entire S&P 500's market value.
30% from just 7 companies.
Yeah. Think
Yeah.
about the math. If 70% of the market by weight is selling off, but the index is flat or up, those 7 names have to be doing some incredibly heavy lifting. It makes you question the sustainability, right? How long can just a few engines keep this massive plane in the air if most of the other engines are sputtering?
It seems like this intense AI focus has just papered over everything else. But this internal weakness is happening while the whole policy backdrop is still really uncertain. Let's talk about the Fed. Washington's issues must be complicating things.
Absolutely. The market is still processing that quite hawkish guidance Chair Powell gave back on October 29th after the FOMC meeting. Remember, the market was pricing in almost a 90% chance of a December rate cut before that.
Yeah, it seemed like a done deal, but Powell really pushed back hard.
He absolutely did. He basically said a December cut is not a foregone conclusion, far from it. And just like that, the odds dropped, now hovering around 67%. You saw that uncertainty reflected in the bond market today, too. The 10-year Treasury yield, it barely moved, up just 1 basis point to 4.107%.
So the bond market is basically frozen, waiting for more clarity.
Waiting for data, yeah.
Which brings us to the other huge problem, the government shutdown. That must be creating a massive data gap right when the Fed needs it most for that December decision.
It's a really unusual situation, especially this far into the cycle. We're now in week 4 of the shutdown, and that means all the big official economic reports, jobs numbers, retail sales, industrial production, they're just stopped, suspended.
So the data the Fed, and frankly everyone, relies on to see how the economy's doing, it's just gone dark.
Completely dark. They're essentially, flying blind, heading into what could be a really pivotal meeting in December.
So what are they relying on then?
Well, they and all investors have to lean much more heavily on private sector data this week. Things like the ISM Manufacturing and Services surveys, the ADP Private Payroll Report. Suddenly, these carry enormous weight.
Because they're the only game in town right now.
Exactly. And if those private reports show something unexpected, especially weakness, the market reaction could be much sharper because there's no official government data to balance it out. It really ramps up the risk around that December Fed meeting.
Okay, huge uncertainty there. Let's check in on other assets. If equities are showing these internal warning signs, you'd think maybe credit markets or commodities would be flashing red too.
That's where things get interesting, because they're mostly not reflecting that same level of fear. It's a bit of a split picture. Look at fixed income. Corporate credit spreads are still incredibly tight.
Okay, tight credit spreads. What does that mean in plain English? What's the signal?
It signals, well, a lot of complacency among bond investors. Tight spreads mean investors aren't demanding much extra yield, not much of a risk premium, to hold corporate bonds instead of super safe treasuries. They're basically pricing in a very low chance of defaults or major economic trouble.
So bond investors aren't worried.
Apparently not nearly as much as the equity internals might suggest, and that's a concern because historically when credit spreads are this tight, there's very little cushion if or when an equity correction does hit. It's like the credit market is whistling past the graveyard while equity breath is screaming danger.
That is a fascinating disconnect. What about crypto? Complacent or fearful?
Crypto seemed to feel the pressure today, definitely reacting to those lower odds of a Fed rate cut. Bitcoin dropped almost 3%, dipping under $108,000. It's actually extending its first losing October in about 7 years. So that weakness reflects sensitivity to Fed policy shifts. Less easy money usually hits riskier assets first.
Makes sense. And oil and gold? Any major moves?
Pretty stable, actually. Oil, WTI nudged up a little, maybe 0.3%. It got some support from that OPEC Plus decision over the weekend to hold off on production increases way out into 2026.
Okay.
And gold is just kind of consolidating. It's holding just above that key $4,000 psychological level after getting hit hard late last month. So commodities are stable, but they aren't really confirming the warning signs from inside the stock market either.
Let's touch on real estate. Always important for listeners. You mentioned an affordability paradox. What's happening with housing?
Yeah, it's still a bit of a mixed picture, keeping overall demand pretty sluggish. Mortgage rates did tick up slightly today, back to around 6.17% APR, mostly reflecting that Fed uncertainty we talked about.
Okay.
On the plus side, we are seeing more supply come online. Housing inventory is up about 15% compared to last year, which is helpful.
So more houses available, rates are a bit off their absolute highs.
Should be helping buyers.
But what's the issue?
The issue is still the price tag. The median home price is sitting around $415,200, and we ran the numbers even with a 20% down payment. Paying the mortgage on that median price home now eats up about 35.3% of the median household income.
Ouch. That's well above the traditional 30% affordability guideline.
Significantly above it. And that's the core problem. For you, the listener, the key takeaway is that until prices come down significantly or wages go up a lot, that 35% burden keeps a lid on demand. Affordability is still severely challenged no matter what the Fed ultimately does with rates in December.
Okay, so summing up the market's mood, we've got extreme selling under the surface, really high concentration risk, but complacency in the credit markets.
Yeah.
And yet the VIX, the fear gauge, is only at 17.44. That seems low.
It does seem low given the breath warnings. And that low VIX reading, it's kind of the final piece of this complacency puzzle. Big market sell-offs rarely begin when the VIX is already high, already screaming fear.
Right, they often start when things seem calm.
Exactly. They often kick off when the VIX is comfortably in the mid to high teens, just like where we are now. It suggests many investors are perhaps unprepared for a sudden shift, despite all these underlying signals we've just walked through.
So the market's heading into November, typically a strong month seasonally, but it sounds like it's built on a pretty fragile foundation. What are the key things to watch this week? What tests does this narrow AI rally face?
Well, the immediate tests are all about tech earnings. Those results will really show whether today's massive AI spending announcements are actually backed up by, real operational progress and results.
Which companies are key?
We're definitely watching Palantir. They've been a huge beneficiary of the AI narrative. Then there's Supermicro, SMCI, which gives critical insight into the actual data center build-out happening. And of course, AMD, which is NVIDIA's main competitor in the high-end GPU space. Their guidance, their commentary, absolutely crucial this week.
And for the bigger picture, the overall market health, what's the most important variable?
It really comes back to market breadth. History just screams that the kind of narrow leadership we saw today, less than 20% of S&P stocks going up, simply isn't sustainable for long.
Okay.
That participation needs to broaden out. We need to see other sectors, smaller companies, join the rally. If that doesn't happen relatively soon, history suggests a correction might be needed to kind of reset things and build a healthier base for any real year-end rally.
Okay, final thought then. We saw $50 billion committed to AI infrastructure today. Amazing number. But just last week, we saw stocks like Meta and Microsoft get punished because investors were skeptical about the returns on their AI spending. So putting this together, what specific evidence should people look for in this week's tech earnings to figure out if this concentration is actually sustainable or if it's maybe getting precarious?
That's the key question. And the answer really boils down to two things you need to listen for. Very clear guidance, and crucially specified timelines for returns. It's not enough anymore for companies just to say, hey, we're spending billions on AI.
Right.
That worked for a while. Now, the market wants proof. It wants explicit, measurable evidence showing how these huge investments are going to translate into actual revenue, into profit, and within a reasonable, defined time frame. If that guidance is vague, if the path from spending billions to making billions isn't clear and concrete, then that skepticism we saw by Meta and Microsoft last week could come roaring back, and that could potentially shatter this narrow AI leadership that's currently holding up the entire market structure.
Lots to watch this week then.
Definitely.
That's all for today's episode of the Daily Consolidation. For more daily market analysis, subscribe, and we'll see you at the next close.